right. Good morning, everyone. Some of the panelists are still getting mic'd up, so we're just going to start with intros, and then everyone will get situated. As George alluded to, this is the Fintech panel. We're going to cover this topic from all sides. We have a few investors in private markets, investors in Fintech platforms. We also have a few founders of Fintech platforms who are all providing solutions for various aspects of private markets. My name is Jeff. I head the research and intelligence function at the Global Private Capital Association. GPCA is a nonprofit, mission-driven association of private equity and venture capital investors across Asia, Latin America, Africa, Central and Eastern Europe, and the Middle East. We connect institutional investors and fund managers across our markets, and we showcase opportunities and innovations across those geographies, with a key focus on sustainability and the digital transition. At the end, we have Edward Talmor-Guerra, who's the founder of Nuvest, a fintech platform of passive index funds for private markets. Nuvest allows LPs to, quote, buy the market in various asset classes in an efficient and scalable manner, similar to ETFs in public markets. And immediately to his right, we have Uday Goyal, who is the co-founder and managing partner at Apis Partners. The Apis Group is an ESGI native global private equity and venture capital asset manager that supports growth stage financial services and financial infrastructure businesses by providing them with catalytic growth equity capital. And to his right, we have George Kaloris, who is the co-managing partner of Tosca Fund Asset Management's private equity and growth capital fund, which focuses on mid to late stage financial services and fintech companies in Europe, partnering with founders and entrepreneurs. Tosca Fund is a multi-asset strategy platform focused on financial services on both the public and private side in Europe, and it's been in business for over 2 decades. And then immediately to his right, we have Keith Tier, who is the CEO of SignalRank, a technology company that uses data intelligence to form a partner network with seed and Series A managers. SignalRank has created a new financial instrument using the follow-on rights of its partners from the Series B onwards to provide exposure to the best early stage companies. And then immediately to my left now, we have Jamie Nascimento, who is the co-founder and chief commercial officer at LemonEdge. LemonEdge, a fintech startup, is a low-code platform for the complex accounting demands of the private equity industry. LemonEdge's private capital product provides asset managers and administrators with the core infrastructure for fund, portfolio, LP, and GP level accounting. So we want to start by kind of setting the stage for you all and providing an overview of the fintech space. And we'll start with the private equity and venture capital investors that we have here with Uday and George. So perhaps first for Uday, give us a sense of how you break up the fintech space, why it's attractive for you as an investor, and where you're finding the best opportunities right now.
So I think most people need to realize that fintech, we're just at the beginning. So this is really automation as well as bringing technology to an industry that's been around for hundreds of years, but for the first time is actually embracing technology in different ways. We started with that probably in the fastest way as the information technology revolution took off and people embraced that technology. But now we are embracing multiple new technologies, including artificial intelligence, distributed finance, as you've been reading about, and a bunch of other technologies that are starting to permeate the space. And that's actually doing it in 2 ways. Probably the first way was really creating automation in the middle and back office, creating information tools for the front office, and then bringing it out. The second one is actually much more interesting, and there's some representation on this panel, which is the concept of the democratization of finance, which is probably going to be the biggest emerging theme in fintech for the next, I would say, 5 to 10 years. which is essentially using technology to take areas in finance, including private markets, to a much wider audience by essentially tokenizing it, creating opportunities for people to invest where they weren't able to invest before. And that was actually accelerated, as you may have seen during COVID, as people embraced platforms like Robinhood and others, and actually for the first time got exposure to asset classes, markets that they didn't have. So when we talk about the breakdown of the different verticals, of course there's the breakdown in traditional verticals, whether that's capital markets software or capital markets technology, where it's core banking, all the way out to insurance, automated credit and others. But for me, actually, the most interesting stuff is the intersection of the idea of this democratization of finance as a theme, and then the other area which is now coming of age is what we call embedded finance. And embedded finance is actually quite interesting. Essentially means that everybody will be in financial services. So whether you think about an Amazon that's now doing supply chain financing for its customers, or if you go to even an Uber, which is doing it on the driver side of any one of these platforms, we're starting to embed finance, and there's going to be a group of companies coming around that, which we call the enabling technologies. And that from an opportunity set is probably the most interesting opportunity set that we're going to see in the next 5-10 years.
Great, thanks, Uday. So George, give us a sense of what you guys are investing in at the minute, and also I think our audience would like to hear. There's been a lot of news about the fintech space recently. There's greater macro uncertainty than ever. Like, how do you see valuations when you're looking at deals these days?
Sure. So we very much, of course, like what Udi said, we see like the segmentation sort of like in the various categories, like from, but I would say we focus on sort of like breaking down to infrastructure of B2B businesses and consumer-facing businesses, or like B2C. So, examples of B2C are neobanks, sort of like free trading, direct lending, sort of like applications. And more on the B2B, you have big infrastructure plays like payments businesses, embedded finance businesses, and RegTech, InsurTech, and so forth. So we have been consciously focusing more on the B2B space, simply because, particularly in the last few years, the economics and the actual cost to acquire a customer base and to become a business of size were such that effectively the payback was way too high, and it was like way too long for businesses to make money. And I think the recent resetting of the market is actually indicative of the understanding by the wider investor community that we need to go back, and when we look at fintech businesses, to look at sort of like businesses that are actually focused on eventually making money, as opposed to eyeballs or users or things which could under an evergreen sort of like funding model potentially be of scale to make money. So that is sort of like where we focus on. Now, in terms of valuations, I think the public market valuation correction is starting to rub off on the private side. I would say that we're still 6 to 9 months away from that being sort of like fully felt on the private side. What, however, is already changing is the deals are becoming more investor friendly in terms of like terms and structuring, which is something we've been focused on for quite some time. And then clearly we're shifting from revenue and top line growth sort of like focus to path to profitability, organic cash flow generation, and ability of a business to actually turn into money. So this is where we feel sort of like the effect of the correction having an immediate effect. And I think businesses who are in immediate need to raise capital will either have to suffer down rounds, or they'll basically struggle to raise capital in some cases if the business model does not justify the ability to raise those funds.
Yeah, that makes sense. Uday, you said something interesting about essentially when we were prepping for this panel about essentially sitting out like the fintech boom over the last 18 months in global markets. Can you kind of elaborate on that a little bit?
Yeah, I mean, look, I think obviously there's been this almost bubble territory in the fintech markets over the last 18 months, particularly in the private markets, I would say, even more exasperated in the private market. That was largely driven by the crossover funds that came from public markets into private markets because they saw an opportunity. If you look at the statistics and between seed, Series A, B, C, you see that bubble very much in the C and D territory, where they were coming in and pushing up valuations significantly. I think to what George is saying, that's going to be highly problematic, I think, for some of those companies as they realign to the new valuation reality to come back to a more reasonable valuation trajectory. And so that pain is going to hurt. And actually, it's quite interesting. There's a parallel between the private markets and the public markets that's playing out right now. I was having dinner with a friend of mine last week who's basically a corporate and M&A attorney for many of the Fortune 500 companies and many of the very large private companies. And the biggest topic at the boardroom agenda, whether it's a private market or a public market, is actually stock options. Because all these stock options now, which were struck during these last 18 to 24 months, are completely underwater.
Worthless.
So you have a massive issue coming down the pipe on talent, because talent right now is so fungible because of these stock options being so underwater that people at the boardroom are freaking out, rightly so, because you're actually about to lose all your talent. And the thing is, as a public company, if you're going to reprice those options, that has a massive P&L impact, and we're just about to go into earnings season, and then the question mark is who's going to take the pain? And so this is the discussion that's really happening up there. And in the private markets, it gets even worse because repricing those stock options is massive dilution for the existing investors. Yeah. And so this, I think, is going to be a massive topic of discussion as we go into this realignment into what is going to become the new normal. I mean, if you heard the JP Morgan strategist yesterday, which is the only kind of good news that came into the market, he thinks markets will go back to where we were even pegging at the end of this year. So really, we're looking at a protracted period where all these companies have massive risk of talent attrition, unless they do something.
Great. Thank you. I want to bring in the others now, who are all, as I mentioned at the outset, they're building fintech solutions that address pain points in the private market. So let's start with Jamie. Tell us about LemonEdge and maybe your model and also your recent experience raising capital.
Yeah, thanks. So I think Jordan, you did say today that there's always opportunities to invest in kind of like good businesses with kind of good business models. And I think kind of the elephant in the room is like we're all very good at investing in kind of technology businesses outside, but if you actually look at technology within private capital, it's historically a little bit behind the curve in terms of using technology to empower kind of the industry itself. A lot of from our perspective, LemonEdge is an accounting platform there to kind of help manage that kind of complex problem. And ultimately, it's become more complex over the last 20 years. And you have historical kind of legacy kind of vendors that are still operating in the same model based on that same requirement. And ultimately, we come in and kind of help solve some of those problems. From a talent perspective, we're seeing that the opportunities to grab talent kind of globally, actually, as this kind of market changes. So, we're a fully remote-based business. We operate right from the kind of the West Coast to Europe and out in Asia. And actually being able to kind of work within that model allows us to kind of secure kind of the very best talent. I mean, we started raising a little over 12 months ago. So we raised with one of our first partners, Psychic Partners. And I think it's, when we were raising, we were looking for strategic partnerships. So kind of that relationship, I think, between the portfolio companies and the investments is just going to become stronger. And actually, hopefully there should be no unknown news when you're having those conversations to, again, strengthen those partnerships to ensure that you can continue to get capital when you need it from the right partners. And then most recently we raised from the Blackstone Innovation Fund. And again, because they could see the potential of the business, underlying we have a very strong business model, recurring business model, which allows us to kind of ride out the kind of these difficult times.
That was relatively recently?
Yeah, so we closed that round in February.
Okay.
So I suppose just before the correction, but we all went in it with a kind of a valuation that was kind of sensible, which means that I suppose the conversation always comes up when we speak to kind of potential clients. Are we looking to raise funds? And we've got really kind of like strong backers, so it allows us to kind of ride the storm.
Have you changed your approach since the correction in any way to kind of take into account it might be a while before you raise capital again, or
Yeah, I think you would hope all of your portfolio companies kind of look at various models about kind of what the risks are within the business, how much runway you might have. And we constantly look to kind of review that based on everything that we have. So fundamentally, we're still on the same plan. But we kind of like start bringing in different options and having those conversations with the likes of kind of all of our investors, whether that's Blackstone, Sidekick, kind of Lauren Islowitz, who was the co-founder of Investran. People who really understand the market, understand the need, and then can like work with us to understand how those markets might evolve. They have a much broader experience than we do from where we are, and having that relationship is really, really important. So I'd say kind of continuing to build that relationship is really important to us.
Great, thank you. Let's bring in Keith as well. So I think many people assume, investing in venture capital is primarily about access to the best entrepreneurs, and it's ultimately, human-driven rather than being about data. So tell us about SignalRank and kind of how you're squaring, the problem of access with a more data-driven approach to investing.
Yeah, well, the name of the company gives a clue, Signal and Rank. So what SignalRank does is recognizes that the next generation of fintechs will be born in seed funds, just as Revolut and TransferWise and Robinhood were born when seed investors discovered them and worked with them and mentored them. And the later stage guys that come later are kind of sitting on the shoulders of those seed investors. There are about 1,200 seed funds in the world today. Back in 2008, there were not. So it's a new phenomenon. And they have, between them, lots of small funds, 50 million-ish under management. And they're the engine room of innovation. It's where things begin. Now, those funds typically, you can't get into them, either because they're so small you can't write a check big enough for yourself, or they're oversubscribed. If you can get in, it's very hard. So what SignalRank has done is we recognize that if we can partner with the best seed managers, and we score them, we have a thing called the GP Rank 100, where we look over a long period of time at who does well and who doesn't do well and how consistent they are. We noticed that typically they only do 1.6 rounds into their best companies. So if you look at someone like Seedcamp in the UK, and Revolut or TransferWise, after they've done the A round, there's no more capital left, but they have the right to continue. So what we do is we go and cut deals with them where we acquire their follow-on rights at the B round, the C round, and the D round, and we roll it up into, if you like, a horizontal opportunity across lots of the best seed managers. And then we go to the capital markets to secure capital to supply that follow-on. And in the top decile of those companies, a 5-year average uptick in the top decile, like the top 2 Seedcamp companies or the top 2 companies in Local Globe or the top 2 companies in Cherry VC here in Germany, will typically do about 30x over 5 years. So the seed stage is huge. 900 unicorn rounds were done by these top 100 seed managers, compared to only 250 in unicorns by Tiger Global. So they're good, they're in every unicorn, and they're out of money by the B round. Well, that seemed to us like a huge counter-cyclical alpha opportunity, and which is what it is. So we raised $5 million of operating capital in February from Lib Bhutan, who's on the SoftBank board, Dan Rose, who's the chairman of Coatue Ventures, Blake Grossman, who was at BlackRock, and a bunch of one of the Tiger founders, Glenn Catcher. So our seed investors are all kind of people who understand what happens next after us. And we're structured as a company, we sell equity, and we invest from balance sheet, giving our managers 5-day drawdown for their follow-on rights at the B round.
So what's in it for the seed and early stage investors that you're partnering with? Can you kind of expand on that a little bit?
Its simple answer is it doubles their carry. So if you think about what they would normally do, that when they're out of money, they get diluted, and they get carry based on the returns from their investments. By giving them money at the B, we offer them 20% of the profit on the investment. We can do that because we're a company. If we were a fund, we wouldn't be able to offer that. Typically you can, by investing in 2 or 3 of their companies, double the carry of the management company compared to what they would do otherwise.
Great, thank you. And Edward, let's bring you in as well. So, we've seen a lot of how the LP composition in private capital funds is evolving, and you're kind of like right in the middle of that. So tell us a little bit about NewVest, your perspective on allocating to private equity and venture capital, and what you guys are trying to do.
Sure. We had a little conversation before, and we were saying, are we positive or negative in this market environment? And I think, I'm personally very bullish, and I think a lot of people coming to this conference must surely be quite bullish about private markets. And so there's a great opportunity, especially in this vintage year, be it in private equity, be it in private debt, and also obviously in tech, which is going to continue to grow with fintech and other areas of venture capital. And coming into a 2022, 23, looking forward vintages in private equity, where market prices are going to be a little bit more attainable for those managers. And in private debt, where you're going to have rising interest rate environment, those are things which are going to be positive tailwinds for these vintage years. And I've been in love with private markets, since an MBA 15 years ago, and it's only ever become more and more of a love. And I believe in this asset class. And with that said, it is very difficult to find the very best managers and to get the access and invest in them. And so our approach, creating really a passive way of getting exposure, is a little bit like sort of the vanguard of private markets, is a way in a much lower cost, much de-risked way of buying the exposure to the private market space, be it private equity, be it private debt, or venture capital and other sub areas, such as emerging areas such as impact investing, which is very close to my heart. But if you take impact, for example, which is great opportunities, a lot of those are first-time funds, emerging managers, very difficult to get access to. We offer an index so you can buy access to all of those. In private equity, all the many managers that are going to be presenting here over the next few days are terrific managers, and they all have great returns, but who's going to be on a relative return? Who's really going to be the very top decile? It is very difficult to get that right. So if you just buy an index, then it's a de-risk way of getting to exposure. And the beauty in the sort of, not to be too academic and geeky on the data, but the weighted average is just way better than just the median. The weighted average comes out in private markets to be around the top quartile. So if I can sort of say, here's a way, low cost, de-risked to get a top quartile level of returns, I think that's a very compelling offering, and that's what we are really about. So very much when I say we are fintech, we are much more fin than tech, so we are tech enabled and believe very much in the need for adopting a lot of the other technologies which are out here as a way for it to be a easy access for LPs to buy the market. But and the democratization point, which was mentioned earlier, we're huge believers in that for many different options that are out there in platforms. But underneath that, you need to have exposure to the right product. And just choosing, if you're an individual and you're just coming into private markets and you're just choosing a Blackstone or another name or whoever, that's great, but actually that's concentrated risk. And if you can just buy the entire market in a very efficient, technology-enabled way, I think that's probably a better approach. And really, the public markets have proven that today. There was a quote from the FT this week that today, public securities are held by passive instruments more than by active instruments in the public markets. We know that the inflows have been more to passive for several years, but as of today, market cap held by passive is greater than active managers in public markets. And in our private equity and in private debt, as of today, there's been no passive way of accessing the market. So that's what we've created, and it's, if you like, a bit of a disruption to the fund-of-fund space.
When you going to make a point to
sure,
add to that,
yeah.
We've been talking about that for years. We always said that passive funds in public markets would overtake the active ones, largely because the drag is so great that over a large period of time it kills it. I think the big difference between private markets and public markets is alpha generation, which has been quite interesting. If you look at private market and particularly private equity returns now over every period since we've been measuring the data, it's always been ahead of public markets. And actually at the median level, it's been around 160 basis points. But if you take top quartile performance, it goes to 1,350 basis points of a difference, right? And so that's where the democratization element comes in, because people want access to this product, which obviously gives you much better returns than it will give you in sort of the public markets, and that's some of the acceleration that we're starting to see.
Yeah, Edward, when you say lower cost, are you comparing to like a traditional fund-to-funds model, or?
Fund-to-funds and many of the other ways in which today access is being provided more broadly. So we, as an institutional offering, don't charge a management fee. It's only a carry-based model for the institutions. The gross to net spread should be to the tune of a few tens of basis points as opposed to a few hundred basis points typically in funds of funds. And just to give a number to stress your point, if we compare to funds of funds, we found it's very difficult. Quote, Warren Buffett, everybody knows Warren Buffett and the Warren Buffett bet, how in public markets 85% of active managers did not beat the index. So we've done a lot of the research on private markets and are able to show that also in private markets, it is very difficult year after year finding the very top quartile and top decile managers, because there is a lack of persistence of relative performance amongst managers. And that makes it very difficult to sort of know who in the future is going to be, in hindsight, the very best managers in a vintage year. But because of the right tail distribution there, which is to your point around why the top quartile and the average is much higher than the median, if you can find a way to just buy that weighted average, which just like in public markets, when we created the PE 50, we're actually an LP in the 50 largest funds in a particular vintage year. So we are investing and capturing 70+% of the capital exposure on a capital weighted basis. So by definition, we just gravitate to the weighted average of the entire asset class. And that's how we deliver those pooled returns, the weighted average returns, which historically have been at the top quartile rate, without having to have a whole management team and everything else, and therefore we can do it extremely low cost.
Keith, what's your perspective from investing directly into companies?
So I'm listening with a smile on my face because I agree with a few things. Number one, the bet, and I think it's at the seed and A round stage, but the best returns are coming with good investors that invest early and are good at doing that. The second is it isn't democratized, because you can't get into those funds even if you're accredited. If you're not accredited, forget it. So there is a challenge to how do you create the Berkshire Hathaway of private assets, where you can trade a public stock that is an index on good private assets. We plan to list, and that's our answer. I think there's other answers. I think taking that systemic approach is great. Obviously, not as a criticism, but just to indicate the difference. If you're exposed to an entire fund in an LP-like way, in other words, you're an LP in the fund and its winners and its losers, you're aggregating the total value of the whole. What we do is, through our algorithm, we call it company rank, we only do follow-on in the top decile of a fund's companies. So we'd argue that our index is kind of not exposed to the losers in the fund, only to the winners. And therefore, you would expect the performance to be higher. But I think, generally speaking, you're hearing a common theme here, which is that the kind of artisan approach to investing needs a more professionalized, institutionalized, and democratized infrastructure that doesn't currently exist.
Thanks, Keith. We're close to the end here, so I want to ask perhaps George and Jamie, starting with Jamie. What's your outlook for the fintech space for the next 6 months, and what are you going to be looking for?
Yeah, and from our perspective, I think it's going to continue to be very, very positive. I think we're right at the very curve of genuine adoption to a lot of things. And what I'd love to hear with the panel is that there's a lot more complexity coming. Whether any of the existing organizations, the democratization, and all of that needs to be supported with genuine technology. So whether you're an LP looking at your GP partners going, how are they enabling themselves to be more technology focused, or as a GP, how are you using technology to get the best returns, what we're currently doing. I think that's an exciting space to be for an emergence of fintech within the private capital space as well. So I think there's a great opportunity for the market, both internally and externally.
Thank you. And George, anything to add to close this out?
Yeah, I think that, given the quite negative sort of like macroeconomic sort of like outlook, I think it's important to stress that fintech is actually very well positioned in that. On the corporate side, in an inflationary and at the same time sort of like recessionary environment, there will be a need for a more aggressive sort of like cost cutting and addressing sort of like the legacy sort of like infrastructure systems that there is no way that the incumbents can do on their own. Therefore, there will be an increase in our view partnering up with fintech businesses. And on the consumer side, clearly, in an environment where cost is going to be even more, so they're going to be more cost conscious and sensitive. Again, the digital services and technology are offering that sort of like access in a much more efficient and immediate way, therefore, to the benefit of those consumers. So we actually say that this is a great time, given also the market reset, for people to be investing in this space.
I just think we're worth adding one point, which is what's going on right now is a combination of technology, but not in the traditional sense. It's a bit of financial engineering, right? So what's going on is essentially you're bridging this gap, as I think somebody mentioned, where you're taking an asset class which wasn't available to most investors, largely because of the complexity of the asset class, drawdowns, the credit risk that you take on an LP, because essentially you take credit risk on an LP, right? If they default on their drawdown, you have mechanisms to actually go after the LP by negative. But you have to solve all those issues through essentially interesting pieces. There's companies like Moonfare that do it in a different way. All of these are actually using financial engineering and then other pieces of new technology to bring that out to consumers. What's interesting is $100 trillion of assets in the world in the asset management industry, only 2%, which is $2 trillion in private markets, right? If you think about that, that's just wrong when you think about where the returns are. And that's where I'm excited about, where this is going, because it's going to be pretty interesting.
Great, thank you. We have to end there. So thank you to the panelists and back to George.
Yeah, thank you, panel.
Thank you all.
Thank you.
Thank you. Okay, so I'm assuming that a number of you know what PCFOs are, so we'll definitely talk about some of the trends affecting the industry, what's going on, some of the interests from the market that we've seen, but there may be a few that don't really know what these securitizations are, so we'll start with just a little bit about the basics. And if we can turn to the next slide, please. Next one. There you go. Thank you. So, Dom, maybe you can start us off just very basic. What is a PE-CFO?
Sure. As Jeff mentioned, it's an esoteric asset class, asset-backed securitization. These are backed by an underlying pool of limited partner interest in alternative investment funds. That could range from private equity funds, private credit funds, as well as real asset funds. The limited partner will construct a portfolio, either a portion or all of its portfolio, and transfer it into a special purpose vehicle or an SPV. That SPV would finance the purchase of that portfolio through the issuance of debt and equity. And those funds, with the debt being sold to external debt investors, and the equity traditionally has been held onto by the sponsor of the portfolio. One unique, so the obligations are supported by the underlying cash flows of the funds of the portfolio. One unique, I think, feature of these private equity securitizations versus other esoteric asset classes is the obligation for the transaction to fund capital calls, which is a little bit different than we see in other securitizations.
And then, so these are some of the basics. Can you talk a little bit about some of the key features that you see in PE-CFOs that help support the deals?
Sure. Yeah, because the cash flows from the underlying funds are not contractual, one of the key features or key elements of PE-CFOs is the availability of a contingent liquidity source. And basically what that means is, and there's two basic contingent liquidity sources, one being a liquidity facility and the other a reserve account. And those really are designed so that if there is market stress and organic distributions from the underlying funds aren't able to meet the interest expenses and capital calls, you can draw on a liquidity facility or reserve account to bridge that gap. I'd say two other key structural features of private equity securitizations, one being LTV triggers. Those are set in place to protect note holders. So if we see a period of market stress where valuations decline, that's where you have an LTV trigger or potential breach of an LTV trigger, which will redirect cash to pay down principal of the notes until that LTV is back into compliance. Lastly, I would say that these transactions have long legal lives, well beyond the expected maturity of the notes. And I think back to the point of periods of market stress, this allows the transaction to be able to weather long periods of market stress where distributions can come in below projected amounts.
Okay, so now we talked about what is a PE-CFO, and now we'll talk about why would somebody do this, right? So in terms of the type of market participants that we see either engaging in PE-CFOs, structuring them or considering them, really can be any type of LP that has a large portfolio of LP interests, that's kind of accumulated over a long period of time. So we've seen secondary funds interested, but in terms of the issuance, we've seen some insurance companies do them, some sovereign wealth funds or asset managers, family offices. Dom, can you kind of highlight what are some of the key motivations? Why would an LP really want to do a securitization?
Sure. I would say there are three primary motivations that we've seen, and maybe more, but I'll cover these. The most popular reason is as an alternative solution to liquidity in your private equity portfolio. So rather than going down the traditional secondary sale, you could use a securitization as an alternative. And in a secondary sale where you lose your exposure to private equity portfolio, if in a securitization you hold on to the equity, if you like that exposure, you could still hold on to it through a PE-CFO and still get some liquidity from that portfolio. And the second reason is to leverage your private equity portfolio. And then thirdly, as for U.S. insurance companies specifically, as a way to reduce your capital charge by securitizing your portfolio and owning just the equity of the SPV.
Yeah, and the insurance motivation is a unique one. Again, it has to do with how much capital they're charged against their private equity holdings. And there have been some developments on that front over the last 2.5 years in the US with the insurance regulators looking at some of these deals more closely. So I think that's kind of dampened the demand from insurers to do these deals. But some of that is getting resolved. So in terms of the motivations, Margaret, you or Azalea has structured a number of CFOs. You're a serial issuer. Can you tell us a little bit about your goals?
Our motivation is really none of the above stated here. At a strategic level, as I said, our mandate at Azalea is really about bringing private equity to a larger investor group. So through securitization, as you know, we would be able to see different tranches of debt coming all the way down, senior, all the way to equity. So for us, we own all the underlying private equity funds. So through securitization, we are able to offer exposure to PE via the bond, via the notes. So when we first started, we offered the most senior note to retail investors. And over time, we intend to offer the junior notes. In fact, as we speak this year, in our Astra 7, we offered the less senior note, Class B, which is still an investment grade note, to the retail investors. And over time, the intention is to bring them all the way down to the junior tranche and equity as well. So it's very strategic for us. It's a measured approach to the way we want to bring PE to retail investors. So at the tactical front, it of course gives us a levered return. We are very comfortable with the underlying funds anyway. So we levered to a level of LTV where we are very comfortable with for us as an equity investors to give us a levered return, and comfortable that we are able to fulfill all the fund obligations under the securitization. And in doing so, we recycle our capital. And yet, we are able to retain our GP relationships because we still keep all the equity. So it's really both a strategic and a tactical motivation.
Thank you. And Jeff, you and I have been speaking quite a bit about some of the interest we're seeing in the market, particularly maybe from U.S. pension funds. Can you talk about that a little bit? What's leading to some of this interest? What are they looking to do?
Sure. And what I would say is about CFOs is it's an incredible tool, but it's really a tool in the overall toolkit. So to sort of understand why you would want to do as CFO, you need to think like an asset manager. And as you look at over time, the interplay between the public and the private markets, they really move as if they're in a tango over time. Sometimes private markets provide better value, sometimes the public markets do. This is on the equity side, but it's also on the credit side. So one of the insights that's developed over the past 20 years, which has kind of fueled fund finance and NAV lending, is the fact that private equity as a borrowing base is very sturdy. This insight started being developed in the early 2000s when there was enough data. At that point, there was 20 years of data that showed that investment in a fund over time produced very predictable cash flows. And if you put 20, 30 funds together, you had very predictable cash flows. And so that was really the underpinning of the CFO, a multi-manager CFO. So as that insight came to bear, the securitization market, the asset-based lending market, began to notice that this is another securitizable asset class. In a CLO, a reference point, you might have 90% debt and 10% equity or even less. In a CFO, typically the ratio is 1-to-1, 50% debt and 50% equity. So, a ripe asset class. Turning that on its head though, if you're a fund-to-funds manager and you can provide leverage on your assets, if a private equity fund returns, let's say 12%, and depending upon where rates are at any given time, if you can leverage that at 4%, at a 50% LTV or 6%, even with all the various startup costs, it's going to be accretive to your portfolio. So one of the motivations over time is not only to create an arbitrage CFO, is to arb the capital markets so that you can enhance your equity returns. And that's actually been very slow to develop. And the insight's there, but the ability to put all the pieces in place, to have the collateral, and then to set yourself up as an issuer and go into it. It's a very thin universe of entities who can do it. Temasek is one, there are a few others who have done it. And typically it's only been for the debt, as in case no equity has been sold. We take the view that in time, you'll be able to sell the debt and the equity because the equity will be an enhanced private equity fund of funds return. And if whatever your numbers on what you see rolling back from an investment in a fund of funds, you will increase both the IRR and the multiple on invested capital. Multiple on invested capital on a fund of funds, maybe we're talking about a 1.5, 1.6, depending upon who you are, an IRR of 12, 13, 14%. Well, those numbers go up with a well-structured CFO, and they go up dramatically. So that's something to keep in mind as the backstop. So who's looking at it today? Well, public pension plans are looking at it for some of these reasons. Some of the public pension plans and some of the larger asset managers have understood the economics that I've just explained to you, that it can be enhancing and that there's very low likelihood of default, given the history, the data now that's now 30 years in, and the durability of private equity cash flows. So they also have another driver, which is what people know as the denominator effect. As the public markets have gone down, their private equity exposures have gone up. And with those exposures going up, they've met or breached their target allocation limits. If a public pension plan has a 12% limit and all of a sudden they're at 14 or 16%, well, it's very hard for you to continue to keep private equity at that level. And as good housekeeping would tell you, continue to invest over time because you don't want to miss out on vintage years. So a way to do that, obviously you can go to your board and you can move that 12% to 16%. That's sometimes hard. Another way to do it is go to the secondary market, take $1 billion out of your portfolio and sell it. That's not hard, but it hasn't been a great trade for those who are selling over time. And the evidence of that is look at all the secondary investors who are out there buying these portfolios at returns that are pretty good. So a third path is to leverage your portfolio. And perhaps the best way to leverage your portfolio is in a bankruptcy remote vehicle removed from your balance sheet so that you can actually take your allocation down. You have a true sale and you're transferring that NAV, among other things, and you can then recycle the capital that comes in and you can allocate it to forward years. So in addition to doing the other things, going to a sale, getting your target allocation limit realized, you can also now create some ability to manage your portfolio in a very safe way. Public pensions are viewing this as an option now. So are other asset managers. Again, it's hard to line all these things up, but the other movement, of course, now is the cost of debt is rising. It's backed up. Public markets have backed up a couple hundred basis points since the Fed started raising rates. So all that provides some difficulty, but there's still a positive arbitrage, and there are long-term strategic reasons for people to engage in this transaction. And we think you'll see some deals come to market within the next couple of years as long as interest rates don't go too high, which again, we're in one of those inflection moments where we all don't know how high rates are going to go, at least in the US. Long answer, Greg, but hopefully.
Oh, very good, thank you. So we're going to go into some detail, touching on some of the points that Jeff made. So this is quite a busy slide, so I'll walk through some of this because I think some of this is important. So on the left, you see kind of a typical structure of a PE CFO, right? You have the equity on the bottom, let's say about 30%, could be a mezz tranche, another 20, and the senior notes, which would be, let's say, 50. Obviously, this can vary. In the discussions with U.S. pension funds, they tend to be a little bit more conservative, so maybe they want 40 or 50% LTV. And so we're going to talk about what are some of the use cases and where do the tranches of the PE CFO or the securitization go. So scenario one is what we've been discussing. So assume you have an LP who's been investing in private equity funds. And by the way, when I say private equity, we've seen different strategies in these transactions. So it could be buyout, growth, venture, could be real estate, could be credit. So it's really all types of private capital funds. So let's say you have 30 or 50 of these funds that you've invested in over time, different vintages. And so you do a securitization. You move them into an SPV. The SPV issues debt, and then the proceeds of that debt issuance go back to you as the LP, and you can, as Jeff said, maybe deploy them into new funds or even away from private equity if you want. The equity is then retained by that original LP. Scenario 2 is the same thing, except instead of keeping the equity, again, as Jeff mentioned, you can actually sell the equity. And scenario 2 is really you've achieved a secondary sale, right? It's exactly the same. You've offloaded your entire exposure. And what happens in a secondary transaction, often a secondary fund will come in, buy the portfolio, and they'll use a bank facility to finance a portion of it, right? So the purchaser, the secondary fund, has essentially done a CFO-type structure, right, where they keep equity or leverage exposure to a portfolio. Now, you can do this as the seller instead of letting the buyer do that. So as the seller, you can structure a CFO, again, 50 or 70% LTV using debt, and then the equity can also be sold. We haven't really seen that happen. I think we've seen a couple of attempts to do that, but I'm pretty confident we will see that type of transaction. I think it really just depends on pricing, kind of how the deal is structured, right? So the first scenario is very similar to just a NAV facility. The second scenario is pretty much the same as a secondary sale. Scenario 3 is pretty much the same as scenario 1, where the owner of the portfolio wants to keep the equity. But instead of doing this as an LP who has a portfolio and you're looking for liquidity, you could do this to purchase a portfolio, right? So let's say $1 billion portfolio comes onto the secondary market, so you can set up a PE CFO to purchase that portfolio, right? You put in the equity and the debt is financed via the debt tranches, in the capital markets. Again, this is very similar to using a NAV facility. And then scenario 4 is what Dom was alluding to in terms of, particularly for insurance companies, maybe for some banks, we've seen these type of deals in the past, where the insurance company who owns the assets will securitize them and will buy back pieces of the equity and the rated debt. And because the debt is rated, it gives them some capital charge benefits. And so overall, they've improved their capital position. Okay. Oops. Sorry, let me go back here. Jeff, maybe just a follow-up to you. So we talked about there are different types of transactions, secondaries, NAV facilities. When do you think it makes sense to do a PCFO versus some of these other ones? And maybe when it makes sense to do one of the other alternatives?
So it depends if you're looking for an arbitrage or you're doing it for fundraising purposes. To me, those are the two various categories of CFOs, arbitrage CFOs and fundraising CFOs. On the arbitrage side, it's just the math. Look and see how you can issue rated notes, whether you at a 50% attachment or 70% attachment, and make your assumption for the underlying private equity funds and run the numbers and see if it makes sense. And if it does, I personally think it's a good business practice as an asset manager to think about that. You should also then look in the private markets and see what a NAV lender will provide you, because the private markets have been very competitive to the publicly rated debt markets. So, if you're looking to enhance your return and to do it conservatively, a 50% NAV type facility or a 50% issuance of single A rated notes can be very accretive. So I think for pure economic reasons, that would be one instance. If you are an insurance company, separate and distinct from that, and you're holding all your fund interests on an equity basis, at least in the US regime, you are incurring large regulatory capital charges. So there are ways in which a CFO can help you reduce your regulatory capital burden, which will flow through to your economic capital results through various mechanisms that are going into it. So, and then if you're looking to take down allocations, as Greg alluded to before, there are any number of ways in which, structured correctly, and that's important, you have to structure it correctly from a legal perspective, from an accounting perspective, you can reduce your exposure if you need to. And from that vantage point, as you go forward in time and you want to be important to your sponsors, you can imagine yourself overcommitting and then laying off excess commitments into the capital markets as necessary. There are a few entities out there who do that, and they do it very effectively, and they become way more important for their sponsor relationships by virtue of the fact that they're able to periodically tap the capital markets. So those would be the cases that I would see.
Thanks. All right, so we have 8 minutes, so I'm going to skip a couple of points just to make sure we get to a few of the points that I think are important. So this is just a quick overview of the history of the PE CFO market. So these are just arbitrage deals or kind of LP-driven deals. They don't include the capital raising type of deals, which generally are also private. There are some public deals. So there's not a lot of them, right? Kind of 1 or 2 a year over the last couple of years. The product is actually not completely new. As Jeff mentioned, some of the first deals were done in the early 2000s. So we've seen some of these deals go through 2008, 2009, and obviously through 2020, the downturn there. But we are seeing, like I said, more interest. So hopefully 2022 and 23 looks a little bit higher. And then, okay, so we'll skip just to talk a little bit about some of the key features. So these are some of the recent deals. You see Azalea shows up there a couple of times. They're a serial issuer. CUNA Mutual, an insurer in the US, has also done a couple. And then you have a few coming in here and there. What are some of the key features? So we've seen the size of the deals. It ranges from, let's say, $300 million to $1.9 billion in NAV. The LTVs, which, by the way, are loan to values, right? So how much debt you have, tend to be from kind of 35 or 40% up to 70% debt, right? And the rest would be equity. And in terms of number of funds, very diversified deals. So it could be from 30 to up to more than 100 LP interests. So that can translate to, let's say, 300 to more than 1,000 underlying positions. So really, really diversified. The types of strategies I already mentioned, it's mostly buyout, but we've seen others, secondaries, we've seen some energy. And in terms of the ratings, they tend to be kind of in the single A category at the top or the senior most pieces. So Margaret, maybe I wanted to turn back to you and just talk a little bit about the process, because often when we talk to folks about PE CFOs, it sounds very complicated. And so we'd be interested to hear your perspective. What is actually involved in doing a deal?
Of course, if you compare it to a secondary sale, it is process in terms of effort and time. First, you must start off with, of course, your portfolio. So you have to come up with your portfolio to construct such that it gives you the desired blended vintage in order to fulfill the obligation of the securitization. A seasoned vintage means that it's going to be more cash accretive. A younger vintage, that means it's going to give you more accretion to you as the equity investor. So at the end of the day, who is it that you are putting this together for? To raise money or for leverage? So it really depends on the motivation. So you start off with your portfolio construction. Because it's a securitization, you have to sell it to an SPV. So there is this transfer from your portfolio SPV to a specialized vehicle. It means that you have to engage with the GPs in the transfer process. So you take some time, 2 months, sometimes more difficult a case will be 3 months. And then, of course, the process, concurrently, you'll be writing up your offering memorandum. And, of course, then you will deal with the rating agencies to get that rated, and leading down to the marketing phase of it. Of course, it's good if you really have in your mind the bespoke investors that will come into your transaction. It really cuts short the process. But for us, we brought the transaction to a listed market on the Singapore SGX. So it involves a prospectus. So it's a longer time frame. And for us, even with that, it's about 4 months, 6 months time frame. But if you offer it in the private placement market, that time frame can be shortened by quite a bit.
Thank you, Margaret. Jeff, what do you think? I mean, you've done lots of secondaries deals. How do you think PCFO compares?
Yeah, I mean, well, first place on the matter of timing and cost. Timing is likely to be longer. If your alternative is a NAV loan or a secondary sale, timing is going to be longer. Cost actually can come into equivalence. It used to be that when you undertook a securitization, there would be significant upfront banking fees and other service provider fees, so you'd have to build that into your cost. But if you obviously go into the private capital markets or even the bank lending market, there's always an upfront cost. There might be an issuance at a discount. So the costs have really come into focus. And obviously for a secondary sale today, there is a cost to hire an advisor, although that has gone down dramatically for similarly sized portfolios. So at the end of the day, the CFO route is going to be a little longer. It could be a little costlier, but what you're doing is you're establishing a long-term repeatable program where you're grooming a base of debt investors to buy into you as an asset manager. And that's a point I would make. The CFO, more than these other alternatives, is an asset management strategy specifically for fund-to-funds managers. I think that in its purest and best manifestation, that is a great option. Let me stop there since we're getting into the...
Thanks. I want to make sure to hit on performance really quickly. Again, this is a fairly busy slide, but we do publish now about a quarterly update on the sector where we put out a lot of performance metrics for each of the deals that we rate and show the waterfalls. So this is what you see here. The bar for each period, the bar on the left is the cash, and then the bar on the right shows where the cash goes, right? So from the bottom, cash goes to pay for capital calls, interest on the deal, and then maybe there's amortization of the notes, and then the rest goes to the equity. So Dom, can you spend maybe 30 seconds talking about kind of performance, what we've seen, in 08 and in 2020 generally?
Yeah, so as you said before, all the Fitch-rated transactions prior to the great financial crisis of 08, they all performed well. There were no defaults. We did see asset valuation declines, but the transaction performance was stable, and all of the notes did pay off. Heading into the COVID downturn, the PCFOs were well positioned with high levels of over-collateralization, and also they were in a very strong liquidity position. We did see some asset valuation declines, but additionally, a decrease in distributions as well as an increase in capital calls to support the underlying investments led to a strain on the liquidity positions. However, none of the transactions required to draw on their liquidity facilities, and they had enough cash from organic distributions to be able to cover the interest expenses and capital calls for the distribution periods through the COVID 2020 downturn.
So kind of what you'd expect, a decline in cash flow coming in, valuations go down, but that's what some of the features that we talked about earlier, that's why they're important. Margaret, anything else you'd like to add on performance, since you've seen some of that?
Actually, Greg has just shown you from Astra 3 onwards, but far back, even before GFC, we had our first Astra 1, and that, as you might know, went through the crisis. Even that one had done very well. All the notes were paid, within the 5 years that we had scheduled that to be paid off. And since then, our Astra 2 and Astra 3 also have concluded its transaction, and all to date, up to now, of course, we just did Astra 7, all have done well. I think key is really you must be fairly, balanced in terms of your LTV so that you want to be able to sleep at night, because as we all know, cash flows from private equity can be unpredictable. But if your underlying private equity funds are of very high quality, that definitely helps out a lot in your performance. So for us, not only just for bondholders, all of them have done well. We as equity investors have done well in terms of having a very good leverage return.
Thank you. I think we'll cut it there. So thanks very much for our panel. And obviously, if anybody has questions, feel free to stop us afterwards.
Yeah. Thank you, Greg, and thank you, panel.